Good morning, everybody. Happy Monday. We will be getting started momentarily. Yep, perfect. Thank you for the audio and visual test. Much appreciated. Let's uh, let's get this week cracking. All right, here we go. All right, good morning, everybody. Serge Berger here from thestudytrader.com. This is our morning call, Monday through Thursday. If you're here for the first time, please make sure you subscribe to our channel. It's very important so that you are able to receive real-time alerts with when we go live with our analysis and be updated also on important podcasts and other research we do. So if you do that quickly right now, that would be great. Let's get started. Serge Berger here from thestudytrader.com. We have another big week ahead. This is always kind of the case, except for a few weeks during the year. For the most part, every week is to some extent important. I've got my notepad here, the top 3 things here, or 4 things we're going to go through here today. Let's get started. First of all, I do want to quickly remind everybody that we do have some economic data this morning, the ISM services data this morning. That's kind of important. And then the rest of the week is, it's really kind of muted, honestly. We've got some economic data, but it's nothing, earth-shattering. So that's just quickly in the news front. Also on the news front, and I think this is important to keep in mind, what we are going to see this week is President Xi of China is traveling to Russia, if I understood that correctly, and he's going to meet with President Putin. And I just want to put that on people's radar. I actually have to check exactly what day that starts to happen. I believe it's later on this week, but I need to check. The reason I'm saying this is twofold. Number one reason I want to bring this up quickly is because I do think that puts the likelihood of some sort of China trade deal this week, since that's the consensus now that that's going to happen soon, puts that probably a bit further on ice. That would be my basic view on that. And it just generally opens up the possibility for headlines kind of more, of those two presidents kind of being together. So you'll see headlines of, those two people together, and that may not be something that certain media like or not. I'm looking at it from a market practitioner's perspective, so I'm trying to put this on your radar for what could be some headlines coming out of there. So that's just something that I'm watching, and again, I'm going to check a bit closer when specifically that meeting is supposed to take place this week. Which gets us to really, I think, one of the more technically important levels that we've seen in quite some time for major stocks and U.S. indices. So a lot of people that have ever looked at a chart before are now calling for this to be overhead resistance. Me too, technically speaking. We've given you guys these levels between 460 and about 4. We talked about 474. Oh, this is the QQQ. Sorry, let me go to the SPY. Apologies. On the SPY, we talked about that resistance area being somewhere between 560 and maybe 580. We're now, more or less right in the middle of that at 570. We closed on Friday. So I still think there's a good chance that we find resistance here. At this point, we need news, right? We need something really good to come out in order for equities to bubble back to their all-time highs. It's not impossible. In fact, for those of you guys that are using our trender indicator, you might have noticed that we received momentum buy signals, for example, in Bitcoin about a week and a half or so ago. We already took that. We already out of that trade again. And we even have a new momentum buy signal in the S&P 500. It's already reached its initial profit target. So it's not like there's no momentum. My concern here at this point is that some news event, and this is the problem with that thought process, that's just going to be critical of myself, is that can always happen. It's just that now we're also at a very critical level where everyone's getting bullish again. If you look at the bulletin boards, the traders, all those people, mostly with very little experience, they're all getting bullish about the new all-time highs. They look at Palantir, for example, and they see that stock is back at all-time highs. So, they're kind of looking through that lens that this is a V-shaped recovery and everything's going to be good. A Palantir, by the way, could be a double top just as well as it could be a breakout. It's not, the jury's still out. So maybe just kind of think about that a little bit. On the weekly charts, let's look at this with a bit further of a further step back. If you look at the indices here, particularly the S&P, on a weekly chart, and you can see that we've just, rallied very, very sharply off of those lows. I mean, we can see that on all charts, but here you kind of see it in a bit of a different lens. But you can also see that we're coming back to a level that has quite a bit of history, right? So the level we're at right now has history of having provided resistance back in September. Then it found support as we came through the election, and then it found support until it broke in early March. And of course, that's when a lot of our algorithms turned a lot of the sectors and stocks in the S&P to bearish in early March. Not because of this level break, but because the algo happened to line up there. And now we're coming back to this kind of difficult level. So at this point, in my view, we need news. And absent any good news, I think we've baked a lot of it in. The contrary to that is what kind of bad news, if and when, would potentially put the market lower. I think at this point we need economic data, maybe something on the trade front that comes out, tariff front that people don't like, but also just economic data. And of course, last Friday, the non-farm payrolls, they came in pretty good. And so you saw the algos immediately go ahead and sell down bonds, buy equities, and that whole entire sort of trade that had worked for a little while, it kind of unwound. And so now we're back at a spot where I think the risk is quite high, A, technically, B, from a news cycle, and C, just from a sort of secular or cyclical perspective for the economy, and D, possibly some of the reverberations of the tariffs that we need to see, that we're going to get some worse data. Again, that's on the credit risk side potentially. Just anything that's economically cyclically that gets worse. That would be what, to me, the risk of the news would be to get things lower. Again, I mentioned before, Xi and Putin meeting this week, if I saw that correctly, that could be a risk, or not, right? But it's just something out there. So that's in the S&P. I think that's kind of interesting. Then let's quickly look at the VIX. Before we look at gold, I want to quickly go over there. It's important, some important things happening there. But this is the VIX. We talked about this last week. We said if you were here in early April, hopefully you were, we talked about the VIX getting overbought. We had all sorts of signals telling us the VIX was overbought and stocks were oversold. And the VIX since has come, from 60 down to now about 23, so that's about a 60+% drop. But we're now, once again, just like the S&P is at resistance, the VIX is at support. So unless we have, amazingly good news, V-shaped recovery and everything is amazing, I think it's going to be difficult for the VIX to drop into the teens on a sustainable basis. So that's what we're watching there. Now, individual stock analysis here applies as well. You look at Apple, it's got the same levels. This is the weekly charts, right? There's a lot of memory here on an end of week basis. As you can see, even when we broke below that level in August, we ended up closing above that level on a weekly basis on the daily charts. And all the charts look the same, by the way. Like all the US charts look very similar, the broader ones. What looks very different is over, for example, in Germany, right? And you look at some of those indices, and the German DAX is not at all at any sort of low or high resistance. In fact, the DAX as of right now is within a hair of all-time highs, right? So, that rotation that I keep talking about, that I think is going to be a theme for at least a few quarters, if not years, of large foreign investors marginally, and I want to be clear, I say marginally, rebalancing their portfolios out of U.S. assets, that's equities and fixed income, is going to, in our view, keep the S&P 500 and the U.S. indices, the NASDAQ too, capped. They don't have to fall apart, but it's keeping capped, and that's going to be a big problem for a lot of people in their 401ks or IRAs, even though they haven't cared yet because they haven't done much yet in the downside this year. But that's something that's important. So, and that gets me to what I think is the chart of the day, and that's really the gold versus silver ratio. If you're waking up this morning or just now and you're seeing that gold is up about 2.6%, I can quickly show you that here. And you might ask yourself, oh man, did I miss the low? Is it back off to the races? For me personally, as I've been narrating it in real time over the past couple of weeks, I remain long gold. So I've owned gold since mid-2023 when the market rover told us to buy gold and own it and still hold it. So I haven't sold a penny. But I am hedged now. In fact, I'm actually over-hedged. I'm actually net short with the hedge on gold through a multi-month, maybe a multi-quarter view. We'll have to see how it plays out. But I don't think that the recent pullback of 8.25% or so in gold was enough. And here's the reason why. The reason why is because we're seeing this gold to silver ratio. So this is probably the most important thing that I'll show you, in my view, that I'm going to show you today. This is a monthly chart. So this is like a long-term chart, right? We can truly call this a long-term chart. This is the ratio of gold to the price of silver. So the price of gold divided by the price of silver. And what you're seeing here is this chart doesn't just stretch back 10 years or 20 years or even 30 years. It goes back all the way to let's call it 30. All right, so that's a long time. That's almost 100 years, 95 years. And the gold to silver ratio's 95-year history tells us that when we reach these levels about now, roughly, this is typically where the ratio peaks. So meaning gold's outperformance versus silver tends to peak here. Now, that doesn't mean that gold has to fall apart from here, but it just means that the relative strength of gold versus silver is likely peaking for the time being. So any number of factors can happen here. Gold can either go down and silver stays put. Silver goes up more than gold, right? Any combination of those where silver has relative strength. And so to me, this is why I'm now hedged gold, and I was actually in silver positions up until about the midpoint of last week. I'm currently no longer in silver because it's been having a hard time showing strength. Even on a day today, silver's up 1.5%, gold's up 2.5% or 2.6% right this second. So, the fact that silver just can't outperform gold yet, I think it's a timing question, a time frame, meaning I think this, if history is any guidance, right, this chart should tell us the truth, but this is not a multi-day chart. This is a, more of a multi-week, multi-month, maybe multi-quarter kind of view where gold might consolidate, silver might go down less or might go up, right, more than gold, any of those sort of combinations. So, for me personally, again, I'm long gold in various ways. I haven't sold a penny. I'm not going to sell anything, certainly not as of right now, but I'm hedged, right? So I'm actually overhedged. I'm actually a little bit net short gold from a hedging perspective, if that makes sense. And I'm looking to get back into silver. But again, I need to see it actually act a bit better. Right now, it looks like it's a lot of just algos and speculators pinging it up and down, but there's no real bid sustainably yet in that. So that is our sort of 15 minutes here to get the week started. I do hope that everyone has a good start. Again, be aware of potentially tape bombs. Our market rover continues to have most sectors and trends in neutral to bearish, so that hasn't changed. But in the near term, from a momentum perspective, as I said before, we do have a lot more things turning bullish momentum. So the S&P 500, Bitcoin, MSTR, of course, and we've had a couple trades in MSTR and Bitcoin last week, closed them, and the S&P too is actually now in a bullish momentum trade. But again, I would trade on alongside in smaller size right now, given everything I just mentioned over the past 15 minutes, and just be open-minded to potential tape bombs, meaning news that would ultimately be risk off and potentially positive for the bond market. So that's how I'm positioned here right now. I think a lot of people, quite frankly, also, as I felt last Friday, and I mentioned it here on Thursday, were quite tired at the end of the month of April. And so it was not surprising that the algos took over. And then with Friday's job print, which was better than expected, we saw the bid come into the market. But again, I think it's a lot of it is a result of people having been quite exhausted at the end of the month, because it was a busy month. And so we'll see what the month of May brings here. But these are the levels. These are my thoughts. Hope it's helpful, folks. See you guys over in Trade Ops in about 10-15 minutes to get the trading day started. And then again, back here tomorrow morning at 9 o'clock Eastern Time. Be well and have a great day.